Alright, Doston, welcome back to Crypto Brain. What we are witnessing right now in the crypto market is not just another rumor cycle. It is a textbook example of how modern financial narratives are manufactured, amplified, and emotionally priced in real time. Because at this very moment, a claim is circulating across social media platforms suggesting that Wall Street strategist and Fundstrat Global Advisors co-founder Tom Lee has allegedly labeled the Toshi project as fake. Now let's be absolutely clear from the outset. There is no verified statement, no official interview, no credible institutional confirmation behind this claim. And yet, despite that lack of evidence, the market reaction tells a completely different story. Prices don't need confirmation to move, they only need perception. And perception, once injected into a fragile sentiment environment, behaves like a catalyst. What we are seeing now is not analysis-driven behavior, it is emotion-driven positioning. Investors are not waiting for facts, they are reacting to fragments of information, headlines, and unverified screenshots circulating in trading communities. Portfolios are being checked repeatedly. Market charts are being scrutinized at microscopic levels, and liquidity decisions are being influenced by fear rather than structure. This is where the psychology becomes important, because the moment a high-profile name from traditional finance is attached to a crypto narrative, the average market participant subconsciously assigns authority to the claim, not because it is verified, but because it sounds credible. And that is the critical vulnerability in this entire ecosystem. The brain defaults to shortcuts under uncertainty. It replaces verification with assumption. And assumption in financial markets is extremely expensive. Now, when we bring Toshi into this equation, the situation becomes even more interesting. The circulating narrative suggests uncertainty around the project, with some calling it questionable or potentially fraudulent. But what matters more than the claim itself is the reaction it is generating. We are seeing a split in behavior. One group is exiting positions purely out of fear. Another group is hesitating, waiting for confirmation. And a third group is aggressively positioning based on perceived opportunity. So you have sell pressure, hesitation, and speculative accumulation all occurring simultaneously. That is not a structured market condition. That is emotional volatility. And emotional volatility is exactly where narratives thrive. Because in environments like this, truth does not lead behavior. Emotion does. Across Telegram channels, Twitter threads, and YouTube discussions, participants are actively searching for confirmation. Some believe there is an interview clip being referenced. Others claim indirect comments were made online. And some are convinced this is a coordinated attempt to trigger fear in the market. However, when you strip away sentiment and examine verifiable sources, there is no confirmed evidence supporting the claim, yet the impact remains very real. And this is where modern crypto markets become fascinating. A narrative does not require validation to influence price action. It only requires repetition, attention, and emotional engagement. Once those three elements align, the market begins to price in belief rather than fact. Now let us go deeper into the psychological layer. Human beings are pattern-seeking by design. In uncertain environments, the brain aggressively tries to connect dots, even when no meaningful connection exists. A price dip becomes interpreted as insider activity. A delay in communication becomes perceived as manipulation. A rumor becomes treated as confirmation. And slowly, without realizing it, the mind builds a structured story out of incomplete information. This is how fear propagates through markets. And once fear establishes itself, it does not remain isolated. It spreads through behavior. Now, the involvement of a Wall Street figure, even at a rumor level, increases the psychological weight of the narrative, because retail investors tend to trust perceived authority more than verified data. That is not a market flaw alone. It is a cognitive bias, and that bias is repeatedly exploited in digital asset cycles. Meanwhile, algorithmic amplification ensures that engagement outweighs accuracy. The more controversial the claim, the more visibility it receives, and the more visible it becomes, the more real it starts to feel, even without evidence. At this stage, the Toshi discussion is no longer purely about fundamentals. It has evolved into a sentiment-driven battlefield. On one side, participants interpret it as legitimate risk assessment. On the other side, participants classify it as coordinated fear or FUD. But the crucial detail is this. Both sides are operating on interpretation, not confirmation. And when interpretation replaces fact, markets become reactive instead of rational. Historically, this is where most emotional trading decisions are made. In moments of uncertainty, traders often prioritize urgency over accuracy, and urgency almost always comes at a cost. So the real question emerging from this situation is not whether the rumor is true or false. The real question is whether market participants are responding to information itself or to the emotional pressure surrounding that information. Because in crypto markets, that distinction defines everything between controlled decision-making and reactive behavior. And finally, before we close today's analysis, one important reminder. Markets do not punish ignorance immediately. They reward emotional decisions instantly and punish them later with delay. So in times like these, the real edge is not speed, it is clarity, it is discipline, and it is the ability to separate narrative from verified reality. This has been Crypto Brain. We analyze behavior, not noise. Stay rational, stay informed, and we'll see you in the next breakdown.